that while you're talking to them. Okay, so for today, we're going to use kind of a case study. So I started a coffee shop called Cup of Joe's Coffee Shop. And this is what the whole framework of today is going to be. I find it easier to have some type of case study, some examples, so we can kind of go through everything and people can see examples. So the example we're going to use is a coffee shop. Everybody knows coffee. We've been in coffee shops. It should be a very easy one to understand. So I started a Cup of Joe's Coffee Shop in 2024. So I'm about a year into it, about a year and a half into it. And I'm at the point that I really need more capital. I need more money infused into my business so I can expand and grow the business. I'm currently the only owner and I'm also the manager at the same time. So as being the owner and the manager, I'd really like to move away from that position. At the moment I'm working 7 days a week, working 10, 12-hour days, and I need to move away from that. I need to be a hire more employees, put a manager in place. But at the moment, I just do not have the capital to do that. And last week, I did my business plan and we did the forecasting, and I'm ready now to find the funds possible to start growing this business. So here's kind of a quick overview for any people that weren't here last week of what my forecasting looks like so that I can bring this to lenders, investors, and I can kind of have a general idea of what the changes will be in the company. So as you can see, for 2025, this current year, we are not doing any of these three revenue streams: the breakfast sandwiches, the catering, and the whole bean sales. That's an area that I think my business can expand in. And that's an area that I need funding for so I can get everything up and running and started. So that going into 2026, I have these three extra revenue streams to start bringing in more customers, more revenue, more profit to the company. And as you can see, I'm going to try to double what the revenue is coming in. So from 2025, we're at 252, and I'm going to try to double that to 534 in a matter of 2 years. So when somebody has, like myself, that much of a growth expectation ahead of them, it's really hard to do it without bringing in any extra resources or funding. Sometimes it can be done, but bringing in some extra capital to expand is really beneficial. We kind of went over this profit and loss statement from last week, but let's just go over it really quickly. So any lender, any investor is going to want to see your profit and loss statement. Even if you're just starting out, you're just doing your forecasting from the initial get-go, you need to have a forecasted profit and loss statement to see what everything's going to be like. Lenders and investors need to see the numbers. They like your ideas. They like hearing about it. We'll talk about that towards the end of the hour in a pitch, but banks and investors need to see your numbers. So you have to have something down. Even if you're a brand new startup, you need forecasting. So as you can see, we have our direct costs and our operating expenses, and just our direct cost is going to more than double in the next couple of years for us to grow. And same with our operating expenses, that's going to increase also. And that's where this bringing in a lender, bringing in an investor so we can have that working capital to increase our overall revenue is extremely important. And kind of get one more look at it here. Our total expenses are going to go from 230 in 2025 all the way up to 416 in 2027. That's a huge growth in expenses. And it's very difficult to say that just all the money I'm going to bring in profit, that I can just put that back into the company and grow that exponentially over the next couple of years. But you can see if we're willing to take on some debt, take on some of that extra, whether we bring in a partner equity or take on some debt with a lender, how much this can increase. A $21,000 profit in 2025 all the way up to $117,000 in 2 years. So this is just kind of a basic framework, looking at the numbers, what bringing on some debt, some equity can do to increase your business. These are just some helpful reminders, some tips that we covered last week. We'll just go over these really quickly. But the three financial statements that most lenders, investors are going to want to see are your P&L statement, your balance sheet, and also a cash flow statement. If you're a brand new startup, these are going to be forecasted. If you've been in business for a while, they're going to want to see some previous years and also some forecasted years. What's going to be coming ahead? What are the three main components of forecasting? Those are going to be the revenue, our direct costs, and our fixed costs. We kind of went over those a little bit in the past statements, but those are the three main areas we need to focus on to do any type of forecasting. Just a reminder on what your direct costs and your fixed costs are. Direct costs are going to be correlated to a product service. So for my coffee shop, a direct cost is going to be the cost of the beans, the cup, the lid, the milk and creamer that go into everything to actually produce that cup of coffee I can sell to a customer. My fixed costs are going to be my rent, my insurance, a lot of the stuff that stays stable month to month, regardless of how much I actually sell in the shop. Cost of goods sold percentage, we went over that in the previous workshop. Once we know this percentage, it's very easy to do our forecasting and see what our direct costs are going to be compared to how much revenue we're bringing in. And the last one, just a quick reminder, is the golden rule that we talked about, the 30-20-10 rule. We want to make sure that we're at least bringing in 30% gross profit margin. Our fixed costs need to be at least 20% or lower, and our profit margin should be at least 10%. Now, these aren't going to be the same for every single industry, but if we can generalize this and kind of think about this through our own business, these are easy rules to follow. All right, so let's get into the fun stuff. So every business owner that I talk to that's starting a business, or if you've been established for a while, you have a story of why you want to get into the business. There's usually a reason, whether you've been a plumber for a few years and you want to go out on your own, whatever it may be, there's always a story. And that's kind of the compelling pitch that you can tell people. Here's a story of why I started this business, and here's what I want to do going forward. So, for example, we'll go back to the case study with the coffee shop. So my story with that is I opened the coffee shop in 2024 with a simple goal of giving our town a true gathering place. There wasn't really any place in town local where people could meet outside of work, grab a cup of coffee, feel like they were part of something. My vision with the company was never just about selling coffee and lattes to people. It was about building community, creating a space where conversations happened, connection formed, and ideas grew. It started out really small. I just had one coffee machine. I was working on my own, trial and error. But as the months went on, momentum started to pick up. Regulars started to come in, word of mouth spread, and people began using the space as more of a meetup location for board meetings and just getting together with friends and family. And that's really why I want to start a Cup of Joe's coffee shop. So something as easy as that, for every business out there, every business owner, you're going to have a story of why you started it. Whether there was a bigger passion to it, whether the service that you're offering is just something that you love, whatever it may be, make sure that you kind of have that story and even practice it. Go over it a few times. So if somebody asks you, why'd you start this business? How did you get this idea? You just have something prepared that you can talk to them about. And we'll go over this a little bit more once we get to the pitch section also. So lenders and investors, how do they think? So whether it's a bank lender or you're bringing in an outside investor, how are they thinking about your business, the opportunity that you're putting in front of them? Probably the biggest thing that they're thinking about is the risk factor in it. What could go wrong with this business you're presenting me? The next biggest one, especially with an investor you're bringing in, is will this actually make money? If I go in on this business, is there a chance I'm actually going to make money from it? Or is there a larger chance that this business is going to go out of business and I'm going to lose all my money? Another big one, like I talked about previously, is the numbers. Lenders and investors are going to want to see the numbers. The numbers are so important to them because the numbers don't lie. It can actually be proof that what you're telling me, what this opportunity is offering, is actually going to pay off. A market opportunity is another big one. Maybe not so much for the lenders, but as an investor, it's going to be very important. So for example, going back to the coffee shop, the case study, if there was already in a small town, let's say Polson, if there's already 20 other coffee shops and I want to open another coffee shop, is there really a demand for that? Even if my coffee shop ends up being the best one in Polson, is there a demand with that many other coffee shops? So what is the market opportunity? And then what is the business model? The coffee shop is very easy to understand. I sell coffee, bakery goods, all sorts of drinks. It's an easy one to understand. If you have a business model where you're selling some type of software, let's say, most people aren't going to understand how your business may actually be making money. So if you have a more confusing business model, make sure that you can clearly articulate it to somebody where it makes sense. Okay, that makes sense. I know how that business is going to make money. Another big one is the team that you have around yourself. So for myself with the coffee shop, I'm basically running it. I'm the manager, I'm the owner. It's going to come down to whether the lender, the investor that wants to invest in me actually thinks it's feasible if I can pull it off. If you have a bigger team, they may be asking, has your manager been around for a long time? What's your employee retention? Do you have a lot of turnover in your company? Because if you have a lot of turnover, they're going to be wondering, well, maybe this isn't feasible. If you have a management team in place for years and years and years, lenders and investors are going to trust that a lot more. And then the exit and payback strategy. This is big for investors, kind of going back to this return. What is their return going to be? How are they going to get their money back? As an investor, am I going to have to give you $50,000 and maybe get it back some point 10 years down the road? Or is there a plan that I'm going to get my money back in the next year or two? What is that exit or payback strategy? And if there is any questions that come up during this, feel free to shoot them in the chat or come off speaker and just speak up and ask me. I'd rather you jump on and ask me than wait till the end. Okay, so the top 3 things that lenders and investors are really looking for is this solid forecasting. So like we talked about last week, doing a good business plan, solid forecasting, and make sure it's actually realistic and there's data behind it. It's tough when you're just starting out as far as, how much revenue you can possibly bring in, what maybe some of the costs could be, but you can do enough research where you actually have some data behind that. Whether how many people are in Polson that are going to come to my coffee shop on a given day, in the morning, in the afternoon, whatever it may be. You need some data behind that to actually show that these numbers are realistic. The repayment ability. So are you actually able to make these payments? If you go to a lender and they say that, we can give you $50,000, but your monthly payment's going to be $2,000 to us. Are you able to make that payment? Can you still make the payment to us, have enough to run the business, have that, emergency fund set aside? They really are going to be critical about that. And we'll cover some of the actual ratios that go into that in the next couple slides. The last big one is there room for growth or improvement? So going back to my coffee shop that I'm starting in Polson, is there room to grow that? Is the population increasing? Is there some coffee shops that may be going out of business that I can take advantage of? Is there a spot open on Main Street where I'll be in front of everybody and I'm going to get a lot more clients? So what is the growth potential? If they give me this money, what am I going to do to actually improve my business and grow? All right, so here's some red flags that if these pop up, investors and lenders are going to take a second thought about it. So not having a clear path of how the funds are going to be used. When I am helping people through business plans and forecasting, that's always one of my first questions I ask. How much do you actually need and what are the funds going to be used for? Some people kind of shrug their shoulders at me or like, it'd be great to have $50,000. The next question is, okay, if you do get that, what are you going to use it for? You're going to buy equipment? Is it just working capital? Are you going to buy a new location? Whatever it may be. Make sure that you have a list of everything that you're going to use for the funds available and make sure that it's something the lender would actually be willing to give you money for. So if you just say, I want a brand new truck so I can put a cool logo on it and people can see me driving around town in it, that's not something a lender is going to be willing to do. Overly optimistic projections. Now, this is very common, and it doesn't mean that's a bad thing either. But we need to make sure that they're actually obtainable to hit whatever your projections are. When I work with clients, a lot of times I just let them be optimistic. We just go through the forecasting once saying, what's your goal? What do you think is totally feasible? What would you like to achieve? By the time we get to the end of it, sometimes it shows that they're going to make $500,000 in the first year. So obviously that's not going to happen. So we need to rein that back a little bit, redo the forecasting and figure out exactly what is feasible. When you start that business out or a couple years in, you're not going to make that much money, but we can project out that you're going to have a lot of growth. So just making sure they're actually realistic projections. Another issue that always pops up is unrealistic or missing expenses. A lot of people don't think of all the expenses that actually go into running a business, especially if you're just starting out. And there's lots of lists online. Usually in the forecasting tool, they'll have a list of expenses already in there. If that's something you'd be interested in, I have a personal list that I use with everybody, and you can just follow that list to see all the expenses that are typical for a business. Big one is no owner investment. So if I want to start this business, I see Kyle, you got your hand raised. Do you want to come off, Kyle? And
Yeah, I was curious on your question or the comments you were talking about with the projections, and we talked about dollar wise and growth percentage. I've heard in the past that dollars amount of growth is less important than percentage of growth when it comes to lenders. Is that true?
definitely, yeah. So when a lender's looking at it, they're going to want to see what type of percentage you can actually grow. What's realistic? Is growing 20% year over year realistic for your industry, or are you shooting for 1,000%? Now, every industry is going to be different, but a 10 to 20% growth rate is very realistic. Sometimes in your first couple of years, even a 50% growth rate. Like when we went back to my original projections, I want to double in size in 2 years. So I'm going to have, 40, 50% growth rate every single year. That's what they're going to be looking at more than what the actual number is. So that's a very good question. And it's easy to figure that out when you're forecasting too. If you say you're going to grow at 1,000% every single year, that's obviously not realistic. So let's find the percentage and go off of that. So no owner investment. This is a big one, especially if you're bringing on another investor, not necessarily a lender from the bank, but an investor that you're going to give it some equity to. If I'm not willing, like with the coffee company, I put in $50,000 of my own money to get the company started. I'm not taking much of a salary the first year. I'm putting everything back into the business. I have a lot of skin in the game to make sure this business succeeds. If I'm not willing to put any of my investments or guarantees into this business, why would a lender or an investor do the same thing? And then inconsistent numbers across documents. This is more if you're an established company and they want to review your previous 2, 3 years and numbers just don't add up. One year you grew a bunch, the next you lost a bunch, just inconsistent numbers. Like we talked about, the unclear shifting leadership roles. So if your manager's switching over a lot, if you have a lot of employee turnover, that's going to be another big red flag for lenders. Like we talked about, no defined repayment or exit strategy. All right, so let's get into the difference between debt and equity financing. There's a big difference and big pros and cons to each that we'll cover. So with debt, basically you're borrowing money and you're paying it back with interest. Just like when you have purchased a house, a vehicle, the bank is going to give you money to purchase your house. You say, thank you, I buy the house, and now for the next 30 years, I'm paying that money back along with interest. There's several different forms of debt that you can take on, whether it's a term loan, SBA loan, a line of credit, and a vendor financing. I think these two are pretty self-explanatory. A line of credit is more for an established business that it's been around for a while. No brand new company is going to get a line of credit. But if you're an established company of solid cash flow in place, but you just want to grow, you can go to a bank and say, can I get a line of credit for $50,000? I just need a little wiggle room to cover expenses sometimes on a month-to-month basis. What you can do is if I have $50,000 sitting basically in a bank savings account, I have payroll this Friday, I'm a couple $1,000s short. I can pull money out of that line of credit account with the bank, pay the bills I need to, Once I have that cash flow back in my personal bank account for the business, I can pay that money back to the savings account with the bank with a little bit of interest on that. Most larger companies have a line of credit all the time, consistently. If you're an established company, I would recommend looking into a line of credit if that's something you need. With vendor financing, that's for with my coffee shop. If I need to buy a new piece of equipment, I could talk to the equipment manufacturer, the vendor, and say, I don't have $20,000 right now to buy this piece of equipment from you. Can you finance that for me? Can I make monthly payments to you? Some vendors are willing to do that. I would say most probably are not, but there are some out there that are willing to do that. Sorry, I just went backwards. The other big one is equity. So equity is actually selling a percentage of your company in exchange for capital. So let's say with my coffee shop, I want to bring in a partner. Instead of going to the bank, I'm looking at, I need $85,000 to grow my business. Instead of going to the bank and knowing that I'm going to have monthly payments to pay that money back, say, let's go find a partner that wants to be a partner in this business. I ask around, I have my pitch, I'm talking to friends and family, outside investors. I say, I need $85,000 to really grow this business. There's a exponential growth that can happen. I just need somebody that can put some cash into the business. I'll give you 40% of my business for $85,000. Equity is very nice to do that because you can get an immediate infusion of cash without having most of the time a definite payment plan every single month for that person. Now we'll jump into that a little bit more in the next slide. All right, so debt. What are the pros and cons of debt? So here are some of the pros. So like we talked about with when you're giving away equity, you're bringing in a partner and you're giving away ownership. With debt, you get to keep 100% control of everything. It's also building up your business credit, your financing history. The interest you pay to pay your debt back is tax deductible. So even though you are getting charged that interest, it is tax deductible for your business. And you have this predictable repayment structure. So I know every single month, if I get $85,000 from the bank, I have to give them back $1,500 every single month. It's just another fixed expense into my business that I can forecast out. Sometimes, not all the times, it can be a quicker access to capital too. When you go out to buy equity or find an equity investor, sometimes that can take a long time. I could probably go to the bank today and start the process of actually getting a loan from them. So sometimes that's a lot quicker. Some of the cons can be, just like I said, some of the pros can be where you have that fixed monthly payment that you can actually forecast into your budget. Sometimes those payments can really reduce your cash flow and make it not feasible to actually take on that debt. If I only have a couple $1,000s of profit at the end of each month and my debt payment's going to be $1,500, that's cutting it way too close. That'd be risk of default for sure if I have a bad month or a bad couple months. Some other things that requires very strong personal or business credit. If you're just starting off, everything's going to be off your personal credit. Even if you're an established business, it's probably going to go off your personal credit. So if you don't have really good personal credit and some assets behind your name, it's going to be hard to get a loan for yourself. Most of the banks and lenders are going to make you have some type of personal guarantee with that loan. Personal guarantees can be, that you always have to pay that money back no matter what. Even if your business goes bust, you have to pay that money back somehow. They can also take on some of your assets, whether it's your house, vehicles, your retirement account, whatever it may be. They can put a personal guarantee on all that. And it also limits the borrowing capacity for the future. So if I took out $85,000 this year and it's a 10-year loan payment, and in 5 years, if I need more money, I'm going to have all that debt still on the business. I may not be able to take on more debt to continue to grow. So some of the equities, the equity pros and cons, like we talked about, no monthly payment. Bringing in, this is probably a big one, bringing in a partner that has some expertise or added value when you bring them in. So for my coffee shop, if I want to bring in another partner, I may find somebody that just wants to do the operations side. I'm tired of being the manager of the business. I just want to be the bigger picture person, thinking about how we can grow and expand and marketing. but I don't want to be the day-to-day operations. I could find a partner that wants to do that day-to-day operations. I could bring them on that fills my manager spot and that gives that infusion of cash that I needed. It also reduces your personal financial risk. Like we talked about, I'm not taking on a personal guarantee with an investor that comes into the company. They're taking on some of that risk too. Probably the biggest con of it, of getting an equity partner, is giving up ownership and control. There's probably, many of you have heard a lot of the horror stories of having business partners. I've had business partners previously. There's been good and bad in that. And it's tough sometimes to make the decisions that you think are best for the company when you have another partner in your business. Whether it's as simple as, where should we find a location, to what revenue streams we're going to have, who should we hire. When you have another person that's going to be making decisions with you, it can get very complicated and sometimes ruin friendships or whatever it may be with that other person that's invested with you. And it definitely takes some time. If I'm going to invest $85,000 in your business, I'm going to do some due diligence, get in lawyers, get in CPAs to review the books, everything else. So sometimes it can take even longer than just going to a bank to get some financing. All right, so we have a choice. Would you rather borrow money, the debt side of things, or would you rather bring on a partner, give somebody some equity in your company? So let's go back to the case study. So whether you're going to scale with debt, scale through equity, or scale through using a mix of both, each path has its trade-offs that can impact your control, the risk, and the growth. So for me at a Cup of Joe's, I made a decision to do the debt financing through a local community bank and partnering with Mission West. I was not ready to give up control of this business that I just started a year and a half ago, and I see the potential that there is in this business. Going through the financial forecasting, I was able to put in that debt payment every single month and made sure that I still have, enough cash flow coming into the business, and it's still going to be very profitable even with that debt payment. So taking on this debt payment, I have all my books in order. I can go to a bank today, talk to Mission West about it. They should be able to get me financing the cash I need within 30 days. Once I have that, I can start hiring staff, increasing the equipment and remodeling the shop a little bit to what I need it to be, start doing additional marketing, and get my business on a growth path that I've been waiting to achieve. All right, so loan preparation. This is always a fun part for everybody. If you've had a loan before, if you've gotten a mortgage before, you know what a hassle it is to go through the whole loan process preparation. Getting a business loan is very similar, I would say, to getting a mortgage. If you just go out and buying a vehicle, usually that's very straightforward and simple. A business loan is very in-depth. So let's go over some of the things that you're going to need. So any type of business information that you have, your articles of incorporation, any operating agreements, your EIN number, all your business information that you have when you started, that's all going to be needed by the bank, the lender, to get the process started. Just like we talked about, how much you're actually looking for this loan. So I need $85,000 for my coffee shop. I'm going to be using 50,000 of it to buy new equipment, do a remodel. I need another $20,000 for working capital, just so I can hire those new employees, have that extra cash on hand, and I'm going to take $15,000 and use it for marketing. So having that detailed out, even the equipment list and what I was going to do with that remodel, having that detailed out for the lender, they're going to want to see that. Financial documents for the last 2 or 3 years, if you've been established. If you have not been established, they're going to want to see financial documents for our forecasting, like we've talked about, but they're also going to want to see your tax returns. So your personal tax returns, and if you have business tax returns. Here's our business plan and projections. Any personal financial info, they're also going to want to know. So if I'm applying for an $85,000 loan, they're going to want to know what's going on in my life. Do I have a mortgage? Do I have vehicles? Do I have a bunch of credit card debt? Do I have medical bills that are overdue and outstanding? You, as the owner of the business, go hand in hand with the business. So they're going to want to know everything about you personally and also the business. And here's some collateral, like we talked about doing that personal guarantee on a loan. So you can do collateral with real estate, equipment, inventory, accounts receivable, cash, and personal assets. One very large misconception about these items are they're not all valued one to one. So, for example, with my inventory, let's say I have $10,000 in inventory. I have coffee beans and cups and all the stuff I need to make pastries and, the cups and lids, everything else. I have all this inventory, $10,000 worth. The bank is probably only going to say that that inventory is worth maybe $1,000, $2,000. Bank is never going to say that all that inventory that you have is worth 100% of what you bought it for. And this can be very difficult when you're trying to apply for a loan, any type of lending, because you have all this inventory that you can sell, but a bank isn't going to use that necessarily as collateral, because a bank doesn't want to have to take repo of that inventory and try to sell it. Same thing when it comes to equipment and machinery. I have $30,000 in coffee makers, but a bank isn't going to take it as $30,000 in collateral. A bank doesn't want to take collateral of coffee makers and try to sell them to get their money back. This is something to keep in mind when you're going through that process. All right, so these, and we're going to cover more of these next week. So we're going to go kind of through them quickly, but if people have questions, let me know. You had your hand up. Sorry, I'm not paying attention.
Oh, it's all good. This might be kind of fringe, but when you say that lenders won't look at your inventory as collateral, is that kind of like a hard and fast rule, or might there be exceptions to that, or is that just kind of out in the weeds?
There's not a hard and fast rule. I'd say most lenders they give a very tiny percentage of what the inventory was actually purchased for. Because a lender does not want to have to take that and then try to resell it. I mean, how is a banker going to try selling all the coffee inventory that I have? I mean, it's going to be extremely difficult for them. So I'd say inventory, most of the time what I tell people is inventory really isn't even worth anything when you go to a lender. If you have harder assets like property and machinery, accounts payable, like we talked about, let's say I'm some type of subscription business like Spotify, where every single month I have all these subscriptions coming in, I have all these accounts payable. So I know that even next month there's going to be $1 million coming in with accounts payable month over month. They'll probably give you 100% of that as collateral, saying, yep, you're definitely going to have that $1 million coming in for the next foreseeable future every month. When it comes to harder assets, you just have to think, how easy is it for the bank to actually sell that if they repoed it and took possession of it? Most of the time, they don't want to do that at all. So they're not going to give you very much for those items, if that makes sense.
Sure. So it's less about how much value is really there, and it's really about how much effort it takes to convert it into loss mitigation, so to speak. Because I think about non-overhead businesses like mine, that our real only value at the end of the year that we could sell off would be our book of business, like doctors or real estate agents or things like that. That's kind of our bread and butter there, but that's not something that we could convert into capital the same way. So I can't imagine that the leverage on something like that would be the same. And so I was thinking about raw materials and things like that, but it really, like you said, comes down to about how easy can the bank recoup their money and how much effort do they need to put into it.
Yep, 100%, 100%. That's exactly right. So for a business like yours, they're gonna go off of this like personal assets a lot, probably. Kyle, you have a $50,000 Denali truck that's paid off. Well, we're gonna take that as collateral because we could probably sell that truck pretty easily. But we are not gonna take your laptops and your monitors and stuff like that. So it's really about how the bank can get their money back. That's a very good way to put it. Thanks, Kyle.
Well, thank you for answering.
All right. So what they want to see, like I said, we're going to go through these kind of quick, so we're going to run out of time. And these will be brought up next week too. So if you have more specific questions about these, either ask me quickly or we can go through them next week.
Hey, Dave, it looks like
Yep.
Christine might have a question for you too.
Yeah, sure.
Can you hear me? I'm so Wilma Flintstone. Can you hear me?
Yep, we can.
Okay, so if you say like you had a paid off Denali worth $50,000, will the bank actually say it's worth $50,000, or if they repossess it? I mean, because I know like people that lost their homes that were valued at like $300,000, and then the bank repossessed it and they sell them for like 100,000. So how do you know the exact? I mean, will they give you the face value, or will they give you like a depreciated value when you're listing your assets?
Yep. So that's a good question. Usually it comes down to a percentage. Now, I'm not a banker and I could even get more info about that. But let's say with a vehicle that's all paid off, they may give you 60% of that total value. Whatever that percentage that that bank, every lender is going to be a little bit different on that, but they probably have a standard percentage of every vehicle that's paid off, we're going to give them 60% of that value. Yep. And same with equipment, everything else. It's kind of like with your mortgage, how they make you put money down on it. So if they had to repo it, they could at least break even when they sell it. But with a mortgage and a house, those are easy assets. They don't lose their value to sell.
Thank you.
Yeah, thank you. That was a great question. Okay, so when a banker's looking at stuff, like I said, we'll go through these very quickly, but they're going to look at your cash flow coverage. I have one more slide about these. Cash flow coverage, your debt to income ratio, what type of collateral, we've been talking about that, your current ratio, your burn rate. I think Kyle brought that up last week, the burn rate, your credit score, your realistic growth projections. We've been talking about that the whole time, and your EBITDA. And EBITDA is a whole thing that we don't need to get into right now. But if you're an established business, they're going to check what your EBITDA is, basically how much profit you have at the end of the year to make sure you can pay this loan off. So why don't we just go to the next page and we'll cover some of these closer and then I'll see if there's any questions about them. So cash flow coverage ratio, so debt to service coverage ratio. I'm just using very simple numbers so we can kind of get a general idea of this. So if in a given year I have $100,000 of debt payments due, I need to be making at least $125,000 after all my expenses go out the door. So after I pay the debt, pay everything off in the business, I need to be showing a profit of at least $125,000. Now this ratio of 1.25 can be different depending on the bank, how long you've been in business, but we're just using a simple benchmark so you can kind of have a general idea of these numbers. Your debt to income ratio, so kind of same thing along these lines, is in a given month, how much income do you have coming in and what is your debt payment going out? Most banks probably want to see a lot below 50%, maybe 30 or 20%. Just depends on your situation. Oops, I went back a slide. Your coverage ratio. So this is more on your short-term obligations. So kind of on a monthly basis. How many current assets do you have? What's your current assets standing at? How much cash do you have in the bank? How many people still owe you for invoices that you've sent out? What are your current assets? And what are the liabilities that need to go out the door? How much you're going to owe in payroll and rent, and how much you're going to have to pay all your suppliers. So what is your current assets and your current liabilities? And this would be on your balance sheet. Sorry, you guys keep doing this. So I'm acting like this is the first time I've given a presentation. All right, then your burn rate, and this is really for startups. I know Kyle brought this up last week, but it's how fast you're actually burning through that cash reserve. So at the beginning of my coffee company, like I said, I put $50,000 into it. And that was really to get me through a couple months of starting this company up. How fast did I burn through that $50,000? Was I going through $10,000 a month, 20,000? How long will that cash reserve actually last me? And the last thing is the credit score. I think most people understand a credit score, but here are some basic numbers. 680 is probably the minimum to actually get a decent loan. Anything over 720 is going to be getting those better rates. Okay, grants. So I'm not an expert on grants, but let's just go through these real quick, and then I'm going to have Weston jump on and just give us his 2 cents. So there's federal programs, SBA loan, USDA, there's state and local, there's community, like the local economic development agency, like Mission West. And then also you got your community banks and your credit unions. And the number one recommendation right here is Mission West. So Weston, could you just jump on for a sec and give us your 2 cents?
Yeah, so as far as financing with us, we do have a loan department. So basically everything Dave just described applies to any traditional loans that you would get from us. But as far as grant support, some things that we can help with. I think the big thing with grants is it's all about what you're willing to take on in terms of grant management. So there's not a lot that we can do at Mission West in terms of identifying and searching grants for you. That's really got to be on you as the business owner in terms of how much work am I really willing to take on in terms of reporting and all of the things that come with managing a grant. But if you have a grant identified or if you need help getting registered on sam.gov or grants.gov, which are great resources for researching grants, if once you have one identified, we can 100% help you. What I would say is a lot of things Dave covered last week and this week are things that they're going to be looking for. So a business plan is a great place to start. And grants are not usually a great way to start a business or keep a business running. There are some grants out there for like computers and printers and things like that that you can find fairly regularly. There's not a really tried and true method to find them. Some of those smaller ones, they just kind of come out and they're pretty low bars to apply for. But those bigger ones, it's a lot of management. I can't emphasize that enough. And it's really just going to be another client. You're not going to retire on grant money. And it's a lot of work to bank on starting a business off of grants. So I would say it's not the best way to start a business, but it can be a great way to add revenue into a running business. Or, like I said, if you're going for a small one for some of the office equipment or things like that, then those are really great. But yeah, that's my 2 cents. I probably went longer than I need to. If you have a grant identified, reach out to us. We're happy to help support however we can on that front.
Awesome. Thank you, Weston. Appreciate that. All right, so let's get into the final section because we're running out of time here. The pitch. So this can be the most important part of you actually finding lenders, finding investors. So I'm just going to give you an easy framework and then I'll do a little pitch for you guys to end this workshop. So for the pitch, there's 5 sections. We need to talk about the problem. What challenge or pain point are you solving? Your solution. What is the product, service? The market opportunity, who are your customers, how big is that opportunity, financials, and the ask. So be very specific. We are asking for X amount of money to do some tips on different types of pitches. So you have an elevator pitch. This is if you're networking, you run into an old friend real quick, whoever it may be, a 30 to 60 second pitch that you can just give them very quickly so they have an understanding of your business and what your needs are. When you go to a lender, you're going to have a longer pitch, a 5 to 10 minute pitch that's going to probably have some documentation, some brochures. You're going to be able to show them the numbers. And that's the same with a pitch deck. Pitch deck is, you're getting up in front of a bunch of people, you're doing a little slideshow, a little presentation where you can actually have the visuals and talk about it. I'd say this elevator pitch is probably your most important one to get down from the get-go. Once you get that, you can start elaborating a little bit when you need to talk to lenders and very specific investors. All right, so I'll do my pitch here for Cup of Joe's Coffee Shop that follows this framework. So the problem, right now we're seeing growth demand at Cup of Joe's Coffee, but limited capacity. Lines are really long, seating is tight, and we're turning away customers during peak hours. We're maxed out, and if we don't expand, we're leaving revenue on the table. The solution, we've built a profitable and beloved neighborhood coffee shop. With additional capital, we plan to expand seating, mobile ordering, and build a small roasting operation to improve margins and brand identity. The market opportunity, our target market opportunity is local professionals, remote workers, tourists, many of whom become repeat daily customers. Based on nearby growth in the community and comparable coffee shops, we estimate a 40% increase in daily volume with expansion and added seated areas. Our financials, we're currently generating about $240,000 in annual revenue at a 53% gross margin. We project over the next 2 years ROI can expand to a modest 25 to 30% growth. We've maintained a positive cash flow and have a debt to service coverage ratio of 1.6. We are asking for $85,000 in funding. $50,000 will go towards equipment and remodeling costs, $20,000 for working capital, and another $15,000 for marketing and brand developments. These funds are going to help us scale sustainably without taking on any more unnecessary risk. So as you could hear, I covered all 5 of these sections as I went. Now that was a very structured pitch. If you keep practicing it, you're going to have a lot more flow with that. I know we're running out of time. Is there anybody that would like to try doing a pitch? I'm putting everybody on the spot, so if you don't want to, that's totally fine. Okay, just a couple more slides. Common mistakes. You're way too vague in your pitch. You don't have a specific problem that you're dealing with, or an audience, or a strategy. Your numbers don't add up. We've talked about realistic projections this entire time. A lot of issues that people see are there's no clear ask. What are you actually asking for? What do you need the money for? Overly technical or jargon heavy. A lot of people will make it way too confusing. Just use lots of buzzwords. Like, for example, going back to that software company, if I was trying to grow a software company and I'm talking about how I code and all this other stuff, that just isn't going to make sense to people. Break it down very simply so that anybody, even your kid in middle school, could understand what you're talking about. Another very common one is way too long or unfocused. You know, a lot of entrepreneurs go off on a lot of tangents because they're just excited about this and they switch topics. Keep it very focused when you're doing these pitches. All right, just last one. Choose the right path, whether you want to do debt or equity funding or finding a grant if possible. Make it packaged professionally, do that business plan, the forecasting, have a good pitch down. And probably the last big one is do your pitch for people, your family, your friends, whoever it is. Your pitch takes a long time to make it sound natural coming out of your mouth. So take the time to do your pitch with as many people as possible. Okay. Thank you all for joining. I try to keep that as close as I could, less than to the hour. Is there any questions that people have or anything that during the next meeting you would like to see? So we have one more that I will be covering some things. Is there any topics that people can think of?
I know I've
Michael?
really enjoyed seeing a lot of the examples. The use case scenario of the coffee shop is extra helpful for me personally.
Awesome. Thank you, Kyle. I appreciate that. I figured something simple like that would make it easy for everybody to kind of relate to and understand from. I don't think we can hear you, Michael. Are you on mute still?
Yeah, no sound is coming through, unfortunately. But I see he's not muted. Okay, so he's working with Kyle. Can you work with him too? So you're in Bozeman. That's up to Dave on that one, but Mission West wouldn't be able to provide any of our funding. We cover a really specific region with our business development funds, but Dave is more than welcome to work with whoever he would like.
Yes, Michael, I can definitely work with you. I work with startups all the time, everything from startups to getting ready to exit your business. So on this slide right here, if you can still see it, here's my contact info. You can even just Google Intrepid Financial Services. I'd love to talk to you more about anything that I could help you with.
And I would be happy to connect you with the other community development organizations in that area. And because there are other people with very similar funding to us that can help pay for that time and things like that. So happy to provide that connection.
Okay. Yep, I'm happy to help out however I can. Rue, do you have a question?
I do. I actually, I was wondering if you have thoughts about like Kickstarters and GoFundMe and things like that as a funding.
As far as like GoFundMe, like on, the actual program on Facebook and everything where you can get funders that come in and want to support you.
Like, do you have any experience with any of that? Or
I don't have anything on that because that gets a little tricky when legally, I think, when you're taking money from other people like that. Would you just be providing them? They would just be giving you the money and you would not give them any equity in return?
yeah, that's typically the way that those kinds of work
Okay.
is like you would promise them product for example. Sometimes, like I just helped fund a Kickstarter for this really cool sand art table that like makes different pictures and stuff like that. I had to purchase the table for a less than retail cost. And then they once they launched, and they've launched now, so like their initial funders got it the table for 120 bucks, but the table retails for like 175
I got
kind of
you.
thing. So like that was the kind of bonus type of thing. But I've also seen where like so I make instant chai latte mixes, and so like I mean I could do something like offer them, chai for every $10 or whatever. I'll give them a package of chai kind of thing for every $10 that they give me. So there is a level of exchange there, but it's not equity at all.
Yep. Yep. And I've actually had, or I'm working with a bar and restaurant, and they did a founders club. So when they first started, they did a founders club, and then every founder menu gets, $1 off every beer they have for the rest of their life or something like that.
Oh,
So,
that's cool.
so there is possibilities like that. I'll just make sure, which it sounds like, don't be giving out any equity for whatever they're giving you in return.
Dave, I think the term that I've heard thrown around in this world is crowdfunding, and I know
Yeah.
Kickstarter is one form of it. So, I know there's a couple different forms of it, but it's always sounded to me, and correct me if I'm wrong, it's basically sourcing funding from multiple investors. The popular ones like Kickstarters and things like that kind of became more of a flash popular way to do it online, maybe, but the
Mhm.
principle is still kind of rooted in smaller amounts with more multiple investors, maybe, right?
Yeah, and that's my understanding is also that they can, if there's people that just want to, just out of the goodness of their heart, want to see you get started, they're more than welcome to give you some funding so you can get started. There is crowdfunding where they're actually getting some type of equity from your business. So you could say that I'm going to keep 90% of my business, but 10% is going to go out to crowdfunding. And you could put a max on how much money comes into that 10% that you're giving out to people. A lot of times it needs to be some type of business that people see a lot of opportunity in, like a software company or something that they think is just going to go public at some point. So they're going to put money in now, wait for it to go public, and make a huge return on it.
So just making sure that you have like a good lawyer to create those kinds of contracts, and
100,
and you're checking in with your accountants and stuff like that to make sure that you're balancing all of your assets and whatnot so that you're
100,
not giving away too much equity.
yep, 100%. And there's lawyers out there that specialize in that. So if that's something you are interested in, I could help you find one. I've never done one personally myself, so I'm not an expert at that. But definitely get an attorney involved that knows the consequences of what you may be doing with crowdfunding.
Okay.
I would, I would, I would probably recommend, if that's the case, talking to friends and family that just want to help you succeed in what you're doing. You could even say, I'm going to give you a 10% return on your investment. If you give me $100, I'm going to give you $110 back, whatever it may be.
Okay. Thank you. This is
Yeah,
great.
that was another great question. I appreciate it.
And Weston, I was wondering when this recording is going to be available.
We usually try to edit them. I can get it over to our people in a couple of days. If you want the raw footage, I can probably have it by the end of the day, but usually I like to edit them up a little and just make them a little cleaner to watch through.
Worries. I was just
So you
waiting
have
on
to edit them.
Kyle's too.
I think the most recent ones, yes.
Yeah,
I will get back to you on those, but I'll reach out and I'll let you know when those are available, but hopefully soon. I'll send over everything I have.
wonderful.
Wes, for my workshop ones, I think I have them linked somewhere. I can get them on over to you. I don't know if you like to package them a certain way, but I think those ones are available. We just don't have them up live anywhere. That they can only be accessed through a link right now. But I think I have those. I can get them to you.
Awesome. Yeah, sounds great. That's our big secret that Kyle does all the editing for us on those videos. So
Great. If I can just get the link for that, because I missed Kyle's second one. I was driving back from Kalispell while that was happening. But yeah,
sounds
no,
good.
these are fantastic workshops. You guys do a wonderful job, and I so appreciate all this information. Like Dave, this has been amazing. Like you've opened my eyes to so much stuff. Um, Kyle's workshop, though, the one that I was able to attend was fantastic. Got me set up on Google already. So
Well,
thank you so much.
well, thank you too. This makes it worth it for us when we have you participating and it's actually benefiting people in the community. That's our whole goal with this. So thank you. Okay. You think that's it, Weston?
Yeah, well, thank you all for joining us this week. Hopefully, we see you again next Thursday for session 3 of financial projections and smart money management. And I will get those recordings out to everybody that's requested them. If you know of anyone else that would benefit from this, just have them reach out to me. But we will see you next week.
Awesome.
Thank
Sound
you.
good.
Thanks.
Looking forward
Thank you,
to it.
everybody.
Yeah, great job, guys. Thank you.
Thank you. Have a great day.
You do the same. Thanks. Bye-bye.